Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, I'll be discussing equity market reactions to the tariffs and what to expect from here. It's Tuesday, April 8th at 11:30 a.m. in New York, so let's get after it. From our perspective, last week's Liberation Day was more like the cherry on top for a market that had been dealing with multiple headwinds to growth all year, rather than the beginning. While the magnitude of the tariffs turned out to be worse than our public policy team's base case expectations, the price reaction appears capitulatory to us, given that many stocks were already down 30 to 40% before the announcement on Wednesday. As discussed in last week's podcast, our 5,500 first-half support level on the S&P 500 quickly gave way, given this worse-than-expected outcome for tariffs. The price action since then has forced us to consider new technical support levels, which could be as low as the 200-week moving average, and that would be 4,700 on the S&P 500. I think it's worth highlighting that cyclical stocks started underperforming in April of last year and are now down more than 40% relative to defensive stocks. In other words, markets have been telling us for almost a year that growth was going to slow, and since January, it's been telling us it's going to slow significantly. In fact, cyclicals have underperformed defensives to a degree only seen during a recession, not prior to them. This fits very nicely with our long-standing view that most of the private economy has been much weaker than the headline numbers suggest, thanks to unprecedented fiscal spending, AI CapEx, and wealthy consumers spending their gains from asset prices. With the exceptional fourth quarter surge in U.S. fiscal spending likely to decline even without DOGE's efforts, global growth impulses will suffer too. Hence, foreign stocks are unlikely to provide much of a safe haven if the U.S. goes on a diet or detox from fiscal spending. Markets began to contemplate such an outcome with last week's announcements. Therefore, I remain of the view we discussed 2 weeks ago that U.S. equities should trade better than foreign ones going forward. That's especially the case with China, Europe, and Japan, all which run big current account surpluses and are more vulnerable to weaker trade. Meanwhile, the headline numbers on employment and GDP have been flattered by government-related jobs and the hiring of immigrants at below-market wages. This is one reason the Fed has kept rates higher than many businesses and consumers need, and why we remain in an economy of haves and have-nots. Our long-standing thesis is that the government has been crowding out much of the economy since COVID, and arguably since the Great Financial Crisis. It's also why large-cap quality has been such a consistent outperformer since the end of 2021, and why we have continued to have high conviction in our recommendation to overweight these factors, despite short periods of outperformance by low-quality cyclicals or small caps, like last fall when the Fed was cutting interest rates and we pivoted briefly to a more pro-cyclical recommendation. Bottom line, equity markets are discounting machines, and they trade 6 months in advance of the headlines. With most stocks topping in December of last year and cyclicals relative performance peaking almost a year ago, this correction is well advanced, and this is not the time to be selling. However, it's fair to say that the tariff announcements last week have taken us to an area with greater tail risk. That includes a recession and financial contagion, and that must be taken into consideration when thinking about levels and adding risk. I see 3 specific scenarios that could put in a durable floor more quickly. Number 1, President Trump delays the effective date for the implementation of the additional tariffs beyond the initial 10% that went into effect this weekend. Number 2, the Fed offers support for markets, either explicitly or verbally. And number 3, a number of nations come to the table and negotiate on favorable terms to the United States. In short, get ready for another bumpy week, and remember markets are looking much further ahead than today's headline. I remain optimistic that the second half will be better than the first, as these growth-negative policies morph into growth-positive ones via deregulation, a better fiscal trajectory, lower interest rates and taxes, and maybe even higher wages for the American consumer. Thanks for listening. If you enjoy the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.